All right, let's go ahead and kick things off. Hello, everybody. Welcome to our Buyer's Blueprint series that we hold here at Happy Cabbage. This is an exciting one because while we have previously always had actual retail buyers on this discussion, this is our first time to actually talk with somebody who works in the CFO accounting space of cannabis retailers, Daniel Sabet with Green Growth CPAs, and he'll be able to tell you a little bit about what they do and how they work so that you understand why we're all here together to talk through financial health of a cannabis retailer. For those of you who don't know who we are, Happy Cabbage, I'll give you a quick intro. Essentially, we help you stock what sells. Our platform is custom built for retail buyers in the retail buying environment to help you with menu planning and inventory budgeting and reordering, like the tasks that take a ton of time to deal with in spreadsheets. We created this platform to help get you out of those spreadsheets and put that time back to the stuff that you actually do that's really great, which is actually getting to know your community, getting to know the brands in your space, coming up with good collaborative ways to work with them and promote products. Our platform is the only inventory management tool built for retail buyers specifically for this environment. So we're solving some unique problems here that retail buyers deal with every single day. And one of those biggest problems is overstocked inventory. When we work with a retailer, on average, we're saving them $150,000 in overstocked inventory over the course of the first 3 months. And that's like aged inventory. That's inventory they never should have stocked, too many days on hand. And figuring out those problems and solving for them saves our average buyer about 10 hours of every week in productivity. So we're putting AI where the tasks can be automated and done more accurately and better. And that reduction is kind of seen across the board. It's seen right on the inventory shelves, which unlocks that cash flow, right? So we're reducing your days of supply on hand by 40%. We're reducing your total SKUs. We're especially reducing the slow moving SKUs. And we're just running really great data algorithms on your POS data to tell you exactly what you should and should not order and in what quantities so that you're managing that cash flow. We have a lot of great customers. They love what we do. You can check them out and see some of the case studies on our website and hear directly from them. But you can see we work with a wide variety of retailers of wide size variety and all across the nation. We integrate with the five biggest and best POSs in the industry. So if you're on any of these POSs, you can work with us on Happy Buyers, our platform, and you can do it for free for the first 14 days. We really believe in this platform. We're very confident in it. And we know that if you get your hands on it for even 7 days, you're probably going to want to buy it. Very few people come out of our 14-day free trial not becoming customers because they're often saving money right then in the trial. We give you live store data connections so that you can actually run these algorithms and reduce that cash flow right away. You'll probably save the cost of our subscription over the course of that 14 days. And if you join the 14-day free trial, or if you just want to get an inventory audit and understand your inventory health, we offer that for free as well. Again, we're very confident in the accuracy of our data. So you can claim an audit for free on our website. We'll show you how much you currently have in overstocked inventory, how much cash we can help you save, how much profit we can help you save, and really dig into some of the actual values of where the problem areas lie and where you can save that money. So if you would like to get a free inventory audit from us, you can go to our website and check that out and get it for free. Now I want to kick it over to Daniel. Give us a quick intro on Green Growth CPAs.
Yeah, absolutely. Thank you, Brad. So yeah, I'm Daniel. I'm a senior manager here at Green Growth CPAs. We're an accounting firm that's dedicated to the cannabis niche. We've been around since 2014, and we have a presence in every legal cannabis state. Majority of our clients are retail, but we also help cultivators, manufacturers, and distributors, or a vertically integrated version of those as well. With the retailers, they're the ones that we save the most money mitigating against 280E. We have a couple different strategies that we can use, but on top of that, we can also help improve their performance and also mitigate their risk in case of an audit. Our methods have always been foolproof. Our methods are very complicated, but at the same time, they work. We've had several no change audits as a result of our 280 mitigation strategies. But I think what people are most happy with us about is just getting them financials in real time so they can understand their numbers and understand what management shifts they need to make month in and month out. And just touch on a little more. We have over 600 cannabis clients. That's a combination of CFO clients or just tax only clients. We also do financial statement audits, and we are registered in the US and Canada.
Dope. Thank you so much, Daniel. Without further ado, I'll kick it off to you, Andrew.
Yeah. Thanks, Thanks, Brad. Hey, Daniel. How's it going?
Okay, pretty good.
Okay, so I'll kind of kick us off, ask you keep the conversation lively, ask you a few questions. I think it's not everyone's always that excited about talking about like, P&Ls and balance sheets and income statements and all of that about, retail. However, I think, both of us know that like where the cannabis industry is at now that like, we're not all getting written necessarily blank checks for investors to just go spend a bunch of money, grow as much as we can, get as much market share as you can. Like financial diligence has become so important, right? Like the ability to find all the cash under the cash cushions, right? 2EDE management, like you were mentioning, we're really focused on like leaning on the inventory management, making sure your labor costs, marketing costs, like all of your stuff is really tight so that like at the end of the day, each retail unit generates enough cash flow to keep it afloat, right? So that way you have extra cash to be able to pay for corporate or expansion or, go public or whatever it is, right? And so I guess like, talk to me a little bit about, let's just start like setting some of the basics. So, you work with hundreds of retailers nationwide. When you're starting to look at a retailer, when you're starting to work with someone, normally what is the like base level financial state that you see them in?
So usually when they're starting out, they have some money raised, so they have some capital behind them, but they need to have a good structure and a good plan. They need to have good projections to understand what their numbers are going to be, and then they have to work around the margins after the fact. So typically, a good operator would have a net profit margin of about 15% or more. Anything below that, they're sort of treading water, and that 15% that includes regular salary. A lot of people, they'll take management salary above and beyond just so they have more take home in the beginning, but we would back that out because that's obviously that should be their net profit at the end of the year. They should be paying people who are working for that salary versus being in that management position. So 15% is typically that range. I've seen some operators that are in the 20-25%, but they're doing exceptional.
Yeah. And when you talk about net profit, right, you're talking about making sure management salaries are in there, talk about labor, marketing, product expenses. How do you think of taxes? You mentioned taxes, 280E taxes, that as net of the profit or are included, excluded? Like, how do you think of that 15%?
Oh, that 15% is after taxes.
Okay. So,
that's the take home.
So pure, like at the end of the day, 15% is overall in the take home. When folks aren't at 15% or they're at negative 15%, generally speaking, your experience, what is causing that?
So there's three costs that are probably the biggest costs of any cannabis business. It's usually their cost of their product, their advertising spend, and their labor. So it's important for us to look at that and see, why they're spending so much in comparison to their sales. I'll give you an example. With labor, typically we'd like to see that labor between 14 to 18% as a percentage of sales. So if your sales are 100,000, you want to be paying your labor at 14,000 a month, $18,000 to $18,000 a month.
Do you think of that pre-discount or post-discount?
Net sales, so post-discount.
Post-discount. So post-discount sales, labor 14 to 18%.
Exactly. Yeah, that's shifted over the years, but at the current moment, that's where we're at, 14 to 18%.
Yeah.
So a lot of times, if it's above that, we talk to them and say, hey, you either need to increase your sales or you need to cut some hours with the staff. A lot of times, people will open the store with 2 or 3 staff, but then when we look at the numbers, those first 3 hours that they're open, there's very little sales, and maybe you don't need that staff to be there. You can do some creative adjustments where that, one of the staff, rather than coming in at 7 a.m., can come in at 11 a.m. and work, half a day, because their presence during those 4 hours isn't equating to any new sales. There's enough people on hand in order to handle those sales that are currently there. And then additionally, it's really important to train the bud tenders to do cross-selling. There's a lot of different reports out there on the POS system that you can create dashboards with, different APIs with the Power BI. There's one that we've put together. It's called Connected Sales, where it tells you which products are bundling well together. So for example, there'll be a client, there'll be a specific flower brand that, we see that people, when they buy this, they also buy this pre-roll. So now it could be part of the sales process that, hey, anytime someone asks for this product, suggest the other one as well. And, 9 times out of 10, they're probably going to say no, but that one time they say yes, over the course of a week, adds a lot to the overall average ticket and to the number of transactions.
Yeah, 100%. And then product, or you said advertising expenses. So what normally is a percent of post discount sales do you recommend folks target for that?
I will keep it pretty lean in the beginning, and then sometimes deliveries have to have more because they need that big network of range of deliveries. But I'd say for storefronts, it should be 5% or less. Yeah, and a lot of times what people do is they'll sign up for some advertising, subscription, and they'll get the highest tier of it, where it has a bunch of features they don't even use, and they could easily downgrade that to a much lower tier. I remember I had a client that was paying, I think, somewhere around 12,000 a month for weed maps, and it wasn't really helping them that much, and they downgraded their weed maps where they were paying only 3,000 a month, and their sales remained the same. So it didn't have much of an effect. It's just paying attention to these little details.
Yeah. Yeah, I do feel like folks are starting to catch up to the whole, like, $25,000 day one for a weed map spin isn't necessarily the best use of money, right? But I don't know. I was just in New York City on the Revel event. There was a lot of newer operators coming out of the woodwork, and unfortunately starting to see some of those early thinkings, but I think at the end of the day, right, making sure that you're monitoring actually how much revenue you're making and managing it to that percentage is it's just basic best practice, right? Because that net profit, you need that pretty much quickly, because there's not a lot of people writing more checks, at least not a lot of people writing more checks at interest rates that make sense, that won't just eat your entire net profit. So
Yeah, I'll tell you, one of the issues with advertising spend is that it's also not deductible with 280E.
I didn't know that.
Yeah, even with our aggressive 471C allocations, that's the one piece, that and the bank fees are the two ones that we don't usually deduct. So now it's if you're going to spend that money, it needs to quantify to a much bigger return, because let's say your sales as a result with the advertising spend go up X amount, let's say $20,000 a month. Well, your cost of product for that 20,000 in sales is going to be probably around 55% anyway. So you're looking at, a profit of 8,000 or so. And then did you spend $8,000 in advertising costs? And if you did, that's not deductible. So technically you're at a net loss right there. It has to be justifiable.
Yeah. Oh man, that's crazy. I did not know that. Actually, while we're on the subject of the labor, how much of that normally do you find, of the 14 to 18%, how much of them can they kind of lump into the 280E deduction normally?
So we utilize this one method called 471C, and the way we structure it is the manager pay and the assistant manager / shift lead pay, we'll take it fully deductible on the 471C. The bud tender pay is the one that we have to break out between the cost of goods sold and non-cost of goods sold.
Yeah.
Typically that's 25 to 30% deductible. But the good thing about that is with the 471C method, the remaining amount won't be non-deductible. It will be pushed into an amortized asset and amortized over 15 years. So you'll get, it'll be a timing difference. You'll eventually get it. And ideally, if cannabis becomes descheduled sometime in the next 2 or 3 years, whatever's remaining on that intangible asset will be fully amortized in that year. So you'll get a big bonus that year.
Yeah, that's awesome. So in terms of like retailers who are opening or scaling in their staffing model, as it relates to the 280E consideration, is it the same point of view that you just had, like keep it lean, don't try to overstaff in the beginning? Is it like you should rotate, like if you're going to prioritize staff, you should prioritize certain staff members because of the 280E consideration? Like what were normally your recommendation there?
It's hard to navigate around that because you do need bartenders. So
Yeah.
the idea of having like more managers and less
Yeah,
bartenders,
that's
like
that.
you're gonna have to pay them more, you know,
Yeah.
and it's like the IRS knows that you can't have, like, if you have a store with, let's say, 15 employees, you're not gonna have 12 managers and 3 bartenders, you know.
You'd be surprised.
Yeah.
Yeah, no, people catch on. Yeah, no,
Yeah.
that
So you gotta, I mean, the way you keep it lean is obviously just don't overstaff, and pretty much look at those numbers. When you do your accounting, look at it month over month over the first 3 months, and then see if you're hitting those benchmarks and ratios. And if you're above that 14 to 18%, then that's where you should be a little bit concerned and say, hey, maybe is this just because we just opened and maybe our sales will catch up in the next month and make up for it? But if it continues to trend in that direction where it's flatline, you got to cut some of the hours on the staff for sure.
Yeah, no, 100%. No, and I think like this is like, I mean, what you're talking about, these kind of rules of thumbs, I really do feel like a lot of folks don't necessarily know the most basic rules of thumbs, right? Like I think they know the concepts of like, I spend money on these things. I think maybe they think in like staffing ratios, or maybe they're responding to like, hey, like we're overwhelmed on this hour, so we need more staff or something like that. But like just knowing, I mean, it's pretty basic. It's a pretty easy thing to be able to know, like if you're spending 30% of your post discount sales on labor, like that's probably a problem. You know what I mean? So I think that's like super helpful. Let's get to the largest thing, right? So this is obviously the stuff that we work on Happy Cabbage side, focusing on inventory, but it's the cost of product, right? That's most of the sales, right? Like that's where most of it goes to. So I think you had just mentioned 55% normally post discount, like net margin 50 or cost. So net margin be 45%, but 55% is normally what you are targeting and advising stores to get to on the product costs.
Exactly. Yeah. So if you have $100,000 in sales, your cost of those sales should be about $55,000.
$55,000 post discount. Post discount. Yeah. For excise taxes, you throw that outside or inside that? Just wondering.
That's outside also. So most POS systems will calculate the net sales, and then they'll have the gross receipts with those different taxes. And obviously every state has like different tax rates. California has.
I was about to say that, so, and then they change it every month. Like,
oh my god! Oh, I think today's when they changed it back. It's back.
Congrats, everyone. That's funny. But okay. So 55%. So talk to me a bit. I mean, obviously, like I have my own perspective on like things that get people not at 55% of that product stuff. I think oftentimes, like, for example, things we see is like they think they're at it because their buyer has been talking to a vendor on the wholesale side. And so they're like, I can get this case at, what is it? Like, $12 a tin of gummies or whatever. And I'm going to list price it at 24 or 25. So I think, okay, that's my 55%. I've done it. But then, like there's all the discounts, and then they're now way below that, right? Then they have the expiring inventory way below that. And even like, you were mentioning, talk to me a bit about like just the basics of data entry that can cause them to be below that.
Oh man, I've seen that happen so many times. Yeah, and what we've done is we work with clients to do it's the report is called the lower pricing markup, and it basically shows you all the products that have been entered and what margins they're showing at. And I was actually pretty shocked by this because this was all human error. You know, a lot of these clients, we'd pull those reports for them and they'd see that a lot of their products are not selling with that 55%, with that 45% margin. And it's just because of human error. You know, the butt tender is the one who's responsible for, or the system manager is entering it into the POS, and they're selling it for too little. You know, maybe some of them they're doing it correctly, but some of them they're not. And even if you make a mistake on, 10 products over the course of a month, that's a significant difference.
Yeah.
So,
And that's in the, no, go ahead. Go ahead.
oh, so yeah, I mean, if you have these reports available, you can catch them in real time. Like before you actually sell, you're like, oh man, we priced this wrong. Let's go in there and fix it before you actually sell it.
Yeah.
Because once you sell it, you're not going to go back to the customer and say, hey, we charge you too little, give us our money back. It's not going to.
And that part of it's the intake, the inventory intake process that is causing that issue, right? So like you may have a buyer who, they're spending all their time working in like all these spreadsheets to try to come up with, the orders and stuff like that. And maybe they're doing it for a few stores at a time, 5 stores at a time. And so, but once they've gotten it in and they've handed it off to the intake team may not have that context or fully. And like the buyer doesn't necessarily have, like, to your point on reporting, like all the ways to like check everything, and they're spending all this time trying to generate the orders anyway, talk to the vendors. And so then the intake team takes it in, and then the intake team, unless they've been like really diligently trained or they're using reporting to like audit and track these kinds of stuff, they may even be putting it in at just a wrong unit cost or a wrong list price, essentially.
Exactly.
Yeah. I mean, like, that's the thing about like, when it's 55% of all of the money you make, it is so much money, right? I mean, what we're talking about is like if a store is doing $300,000 post discount net sales, what is that, like $155,000, $160,000 of what they've done is they've spent it on inventory.
Yeah.
Right. And like, and folks, and it just occurs to me, and obviously part of this is like, why we build technology to help people manage the inventory, just like on the very basic level of like, how can you get the orders in minutes accurate? Like, how can you turn it over faster? How can you make sure that like you're moving it from the back of the house to the front of the house at like the appropriate times? How can you prevent overbuying? But like, it just like the amount of money it is, it's just sometimes I just feel like there's not necessarily the proportional focus in the organization on how to manage it, or tactically how can you manage it, right? Versus advertising, like we're talking about, right? Like people spend, I think, a lot of time thinking about billboards and weed maps and text message marketing campaigns, which are great and they drive sales and they're awesome. Or honestly, people spend a lot of time worrying about tax regime changes and regulatory things, which is a huge thing. But like, how much are people actually investing their time, energy, and effort into managing to that 55%? And I think this is part of like as we evolve, but when you're advising folks tactically, right? So I mean, you mentioned auditing the unit prices and the unit costs. When you're tactically managing like someone who's just way off that 55%, what is normally the list of tactics that you're giving them out the gate to try to execute?
You're saying in-house or what to do with the vendors?
Well, I think, if you're talking to a retailer and then it's like you're opening up the P&L and you're basically seeing, okay, they're not at that, like either way, like if it's something in-house or if it's something with the vendor, like how do they get it? How do they change it? What do they have to do?
Okay, so the first thing we would do is do that audit on, the markups to make sure that they're actually entering it correctly. And then if that's not happening, we would ask them to go back to the vendors and either ask for discounts or credits or something of that nature, because chances are they're probably buying it for too high for what they could actually sell it for. And a lot of times in the cannabis industry, things change. You know, I've seen flower prices, you know, in certain markets start really, really high, and then within a year and a half, they plummet completely. And a lot of these vendors, you know, they have the relationship with the retailer, and they, you know, they have in their mind they have a price that they sell it for them at. You know, they say, you know, I'll send this to you every month. It's going to be X amount. But you know what this is now compared to what it was 6 months ago could be night and day. So if I was the vendor, I probably wouldn't tell the retailer, hey, prices have gone down, so I'm going to sell this to you at a discount. You know, it's on the retailer to go to them and say, hey, uh, this is the current state of the market. This is the data to back it up. I'm not able to sell this and make my 45% margin. Therefore, I need you to discount this a little more. And you'll be surprised. Most of them will say yes. You know, they want to keep that relationship going, and they understand, you know, things have changed, but at the same time, they're not going to go out of their way to tell you, hey, I'm going to sell this to you for less.
Yeah, no, 100%. I think to the ask the question is big. I think know which brands you have that aren't at that is big. I think then asking the question, hey, I need to get there is big. And then I also think it's like understanding, like, you know, like I mentioned, like a lot of folks, like, you know, they keystone, they kind of think, they kind of like, oh, like, you know, I'm doubling it, I get it from this, I'm doing that, you know, I'm handling it. But then, you know, with the overbuying, which is something that we see that's fairly pervasive, and the fact that they then need to like pay the brand back within the net term, so they need the cash to be able to pay the brand back. And they're like, oh, I don't have enough cash. So then they're like, okay, we got to discount it because it's aged. We got to discount it because it's expired. And they think like, well, that's just what I do. But the net effect of that is you're now below the 55%, right? Because when you BOGO it, what is that? That's a 50% discount. When you BOGO something, you're effectively selling it at wholesale, right?
Yeah, that's nuts.
So that's just one thing that we really help laser in on is like trying to get, I think we were just talking before this call, right? Like around like if you have inventory that's aged over 60 days, like that's a huge amount of cash that's tied up in a shelf somewhere that you can't use to pay. And if you're going to try to free that cash up, what you're going to do, the tactics you are going to do to work to free that cash up is going to bring down your overall net profit. Right. And that's where it's you can negotiate with the vendors, you can try to get brand credits and all that kind of stuff. But on some level, if like you just didn't have all that aged inventory in the first place, you wouldn't need to like do the tactic to then erode down the margin, right? Net. Right. So
yeah, there's a lot of trial and error in this business. So I think once you recognize that you're buying too much of the product, that's where you could scale back and say, if I can't get this product off my shelf in less than 30 days, then it's probably not worth buying as much as I'm buying.
Yeah.
And that's on average. Obviously, there'll be some things that sell within 10 days and some that go to 50 days, but you want to keep it under 30. And ideally, most of these retailers, they have net 30 terms with their vendors. So in essence, if you're able to sell all your product within the 30 days, it's almost as if you're buying everything on consignment. You're getting the product, you're not paying for it. You're selling it all off, making all the money, and then just paying back the vendor what they gave you. That's a consignment model, but
yeah.
you're creating a consignment model by just getting rid of it as fast as you can and without discounting it, of course.
Yeah, exactly. Right. It is interesting, right? Because like, when you compare this to like, I've done some stuff on the BevElk side, talk to folks on BevElk, like they have fairly structured, right, ways distributors have these things, ways that like they've been figuring out over years and years and years of these like models of like consignment versus COD versus like what those things, and they've like lined it up pretty well. But when in cannabis, it's just like it's a free for all, basically, right? Like there aren't necessarily state regs that say that distributors have to give the same wholesale price to everybody. There aren't necessarily those like, there's that, but that flexibility provides huge opportunity for retailers to really get a ton of margin leverage quickly, purely through relationship building, purely through, how can I make sure that my net terms are good, and purely through making sure that I'm turning over the stuff like in an appropriate amount of time. overall, right? So it's both a opportunity, and it's also like if you aren't doing that, like you're right, like the brand's making like at the end of the day, like that to your point, like they know the price is going down, and they love it that you're being locked into a higher wholesale. They just do, right? Like that's what they want. One thing we hear a lot as well with that is just like, folks that try to do bigger orders because they get better terms from the vendors, right? What's your opinion on that? Put you on the hot seat.
I mean, this is a cash flow business, so you have to think of it as like, if I buy less, even if it costs me a little more, if I could turn it over quickly and then buy more after that, long term, I'm going to be profiting much more. Buying too much product and then letting it sit on the shelf and age is not a healthy way to do business at all.
Yeah. Even if you think you're getting a better term. And I think the point that you're making on like wholesale costs just go down. They just do. Like that's the gravity of the industry. That's called like capitalism. That's competition. That's like you grow more, you make more stores, you have price competition, like things go down. Which actually that reminds me, when you're doing normally like forecasting stuff or like early store stuff, how much do you like model in or think about like price compression? Or how do you talk to retailers about like long-term price compression, that kind of stuff?
I mean, when we do performas for new clients that are just opening, we try to use historical data on what we've seen in similar markets. We compare markets by, what's a limited market versus a non-limited market. For example, right now we have a lot of clients upcoming in Minnesota. We treat that very similar to the Oklahoma market, and we went through the Oklahoma market and we saw what happened there. There were a lot of shops that opened up at the same time. It was fast and cheap and easy to open up a shop. I think it was like $2,500 to open up a shop and took 4 months. Problem is everyone was doing it. Oklahoma is not a market where it has like a huge population everywhere, and it's also a medical market. So at some point, we had clients that were doing $200,000 in sales. They dropped to $60,000 a month in sales. It was crazy.
Wow.
And then now it's kind of like the strong have survived there. But when we were doing performance for the Minnesota market, we were using some of that historical data that we saw from Oklahoma to say like, okay, you're gonna get this price now, but it's gonna definitely drop in 6 months, and then 6 months later it's gonna drop again. So we're blessed to have that historical data to be able to make those determinations for them.
So what is that like? Are you thinking, 10% per year, 20% per year? What is your had to take it to Vegas?
I'd say the first year it drops like 10%, but then the second year it can drop 20-25%.
Wow.
Yeah, that's when usually 2 years in is when the saturation happens, and then it just like you'll see you'll see a more drastic drop. It's not linear.
Wow. That's actually, I think that's super interesting. I think folks realizing that, because you're right, like they know like the thing, they see the 10% drop in the first year, they're like, okay, like I get it, like I'll just model a 10% drop next year. Right. And I think that second year shift, particularly because that's when a lot of that earlier capital, it's starting to get used up a bit, right? Like, you've acquired your customers, you're like in the game of like, how can you provide a consistent, well service? But then that store that had their, licensing delayed is finally opening up, right? And then you see that 25, I mean, that's crazy. That's a crazy stat. I guess my question is like, how long do you think it takes to bottom out?
I'd say by year 4 of the market being open is when things will plateau, and then you'll see some people go out of business, and then the ones who were well funded and ran their shop the right way and were able to weather those storms, they'll start to gradually make their way back up. I've seen that happen not just in retail, in all different verticals in all different states. Some of our best clients who are in retail, they're like, we had a client in Oklahoma that they had like 7 retail stores. We still work with them to this day, and Yeah, after, I think 2020 was the beginning of the Oklahoma market.
Yeah, I think I
But
remember.
yeah, by 2022, end of 22, early 23 is when we saw a lot of shops closing down. Prices went down, sales went down. Uh, but then now, they did some things. They had a moratorium on new licensing, so now people would just buy existing licenses that have shut down, built out already stores. It was actually very opportunistic for them. And then the price was low, but they kept their margins high by just cutting staff, running it very lean. And then as shops closed down and these ones stayed, prices started to rise just a little bit, and then margins continue to grow. So that's usually what happens in any market.
Margins grow from the scale, right? Like, because at that point you can get scale if you have 10 shops, like you're actually at the scale. So the trick you're saying is you make it through 4 years without running out of money.
Yes,
Then the market is yours.
exactly. You gotta have some good capital behind you, and then you
Yeah.
also have to, when you're for operation purposes, you have to do all the little tricks like, you know, buy product on terms, get rid of it within those 30 days. And then you'll be surprised how a few small tweaks, looking at your average ticket sale and looking at, number of transactions and making it a goal to increase that average ticket sale by X amount. Like if your average ticket is $70, you can present that to the bud tenders and say like, hey, every time you make a sale, try to go above the $70. If they buy two products, try to sell the third one, and just make that a practice, because there's a little bit of fatigue when it comes to the work with the bud tenders. They won't consistently make those recommendations. They're just trying to get through the day. There are some ways to incentivize them too. We've suggested doing bonuses with bud tenders, where it's like, if the sales go past this threshold for the day, every additional sale there'll be some sort of commission paid out to you, and people rally around that as well.
Yeah, just like the simple tactics. I mean, what you're really getting at is also just like, what are best in class SOPs for every level of the staff look like, right? Where you're not like, people aren't, and this is part of the industry. Like, part of it is like, no one has 50 years of experience in adult use cannabis retail. Like, that just doesn't exist, right? The way that there are people who have 50 years of experience in grocery, right? Or there are people who have 50 years of experience in apparel, right? Like, that exists. And I think part of that is like, people are on some level like learning the SOPs as they're going, because like they're learning the nuance of the job, right? And not every SOP that works at Erewhon or something, they're opening an Erewhon across the street from me, so like I'm thinking about Erewhon. But not every SOP that works at Erewhon is going to apply to cannabis. And so just because like, oh, they do this there is going to work. But I think what you're talking about, like just the most basic little, like every role, like what is the little thing, the buyer, how can they make sure, just turn it over within the terms, the bud tender, get the ticket size up a little bit, right? The marketer, keep the budget within, 4 to 8% of sales, right? Like just these tiny things that like, I agree, like can yield huge benefits into getting you to that net 15% margin and making it so that you're surviving for 4 years, right? But then I also think there's a little bit of like, people don't even realize, like, I'll take the Erewhon example, right? You go to an Erewhon and it's like every shelf is so glisteningly perfectly organized, right? And the reason why is because like the SOPs that they dial in for the staff there are so detailed and so aggressive, right? And people don't necessarily realize the level of that you actually need to run a really dialed in shop, right? But you also don't need to start there. Like, you could start with the like, like weekly contests with the bud tenders every week, like, that kind of stuff. So
Yeah, absolutely. I've noticed them. You got me hungry talking about Arrow, and that organic mac and cheese at the hot bar is like something.
Oh, I just hear about the Haley Bieber smoothie. Like, I still haven't gotten one of these Haley Bieber smoothies, but that's what everyone's talking about. For those on the call who don't know what Erewhon is, it's a incredibly bougie, inaccessible. I have actually never purchased anything at Erewhon. I have walked into it, grocery store chain in Los Angeles. But apparently I got to try the organic mac and cheese. But yeah, but now they're gonna have one. That'll be my closest grocery store. So, but anyway, we're running just up on the 15-minute mark. We can kind of shift to a Q&A. I guess like any last thoughts, any last things before we kind of move into a little bit of a Q&A here. I know that there's good amount of questions that have been popping up in the channel, so keep them coming. But yeah, any last like thoughts to give for the team?
I guess one thing I also want to mention is there's a lot of people who have inventory that's also damaged, leaking, or set to expire, and it's really important to monitor those. And a lot of times they're damaged when they receive them, but they didn't know, and they just kind of put it to the side, and then 6 months later they realize, oh wow, this was damaged the whole time. It's really important to get on top of that right away, and then reach back out to the vendors and say, hey, thank you for all the product, but X amount was damaged. It wasn't packaged well. I can't sell this stuff. I'm going to send it back to you. Please issue me that credit.
Yeah. Yeah. Getting that, just dialing on that monitoring and intake process. That's a really good point. That's a really good point. And what I also, what I've heard anecdotally is that, on some level, the vendors respond to the retailers who have more diligence about it. Right. And they know that if they're going to be sending packages that aren't packed well, they're going to have to be dealing with going back. So they just it's just, squeaky wheel gets the grease on some level. So by providing that feedback, like you can also manage it from happening in the future. Yeah.
Right. Well, let's kick off some questions. We got a lot of really good questions in. Thank you guys so much for all of your inquisitiveness. You came curious, and I like that. I had to actually put topic headers on some of these because they're very specific questions that deal with a very specific part of this conversation. So on the part of the conversation where we were discussing 280E deductions and tax codes, I don't remember the tax code you said that you usually file some of those labor deductions under, but in that 14 to 18% range that we were discussing. First question is that 14 to 18%, is that for California? New York was mentioned, wasn't sure what state.
I would say it's universally. It's across all states.
Yeah.
Yeah.
That's a target of how much you should be spending on labor.
Right.
Regardless of 280, right? Like how much you should be spending on labor net sales of discount as a percentage of your net sales.
Yep. The other question, and I know these tax codes don't necessarily apply here, but I also know that you work in Canada, and we do have someone who's watching who runs a retail store in Canada, and she asked, are the tax codes you're referring to Canadian or US? And if not, obviously the same tax codes, what are the tax codes you usually employ when working with your Canadian retailers?
So for Canada, we don't do any outsourced CFO type work. We are just registered in Canada so that we can do financial statement audits in there, because our firm has 3 different legs to it. We have, the tax preparation, we have the outsourced fractional CFO, which is getting the books ready for the tax team and applying all these different allocation methods. And then we also have a department that does the financial statement audits, similar to what PricewaterhouseCoopers and KPMG and those firms would do for for any company who wants to go public or even private. And I was just mentioning that a lot of these bigger cannabis companies, they do register in Canada, so we do have the capability to do those audits in Canada. But as far as the tax stuff, we don't deal with that on Canada level, just US.
Right on. On the tangential subject of what percentage of your net sales you allocate to certain things, we have a question of what percentage of net sales do you typically like to see rent expense at?
Rent expense should be at 3 to 5%.
Rock and roll.
Typically what I've seen.
I've heard that benchmark too, about 3 to 5% facilities.
So let's talk about the intake issues, like mistakes being made on intake, and how the data kind of is working in a typical retail store. This person asks, our store seems to just have different sets of information we're working from. CEO has data about stuff. I run my own spreadsheet of inventory. Marketing has theirs. How do you manage from the same data so we aren't misaligned from each other? I think what you were saying when this question came in was specifically about being able to catch when a mistake happens. Who's catching that, where that report comes from. Is that the same data that the CFO is looking at, that the buyer's looking at, that the marketing people are looking at? Like, how do you make sure that that unification happens, I guess, is the subject.
Okay, so a lot of this data gets entered into the POS. The POS a lot of times would have an API with QuickBooks, or if it doesn't, we can pull reports and journal them into QuickBooks, or whatever accounting software they're using. But the information, there's like it's all there in the POS. There's special reports for it, and our firm also, to make it easier for our clients, we create a Power BI dashboard that syncs with it. So that way you can just, with one click of a button, you can see these different reports. And the report that I was mentioning, it'll just show you all the products that have been entered and what margins they are at, so that when they sell, you're going to hit this margin. And if we see that those margins, like going down that entire list, if we see that they're not all set at that 45% margin, then we know that there were input errors. So that's so the errors exist because product is coming in, they get the invoice, they enter it into the POS, but they're just entering it incorrectly. They're maybe using the wrong number, or they're doing it too fast. It's the human error aspect of it. That guy is a bartender. He has a customer coming in and he wants to just enter it really fast so he can go about the sales floor. And that's why just having those reports in the POS and just monitoring them is how you fix it.
So like really you're putting together like a Power BI data center, data house, if you will, that each of those different like roles are connected to, that so that they all working from the same source of truth, essentially, which is the POS.
Yes.
Yeah.
Yep.
And I think it's like that's where, building then the SOPs around it, right? Like knowing, like at the end of the day, it's an SOP to, like, hey, like on Monday morning, right? Or like when the intake happens, you go to this, you check this, you make sure it's this, right? And like you really line that up, and then you hold people accountable to like monitoring those reports to know that. Now I think like, let's be real, like POSs have various levels of limitations of like surfacing that in ways that are usable, right? Which is, why folks like us exist, to be able to like, really help with that, which makes sense. Like a POS is at the end of the day, it's a compliance system and a payment system, right? And a transaction system. It's not necessarily an SOP system, or it's not necessarily a like how to make the business a literal financial juggernaut system, right? And so like, that is why it's okay to have the expectation that you need to go further in order to get to a level of excellence to be able to run your business as well.
Yes.
Right. It sounds like the actual takeaway to this question is really more about like operations, right? Because like whether you're working from the same dashboard or you're having to pull reports, like you have to make sure that the operations allow for each of those roles to be communicating on the same sets of data and seeing the same information, so that marketing's not out there just like promoting something when your buyer's looking at that like stocked inventory and saying like these have way higher margins and I got them for a really good price. Like these are the things we should be promoting, but like, they're sort of siloed off, I imagine, right?
Yeah. And I would say to that point, right? Like I think sometimes folks, we deal with this with like, how folks who adopt our inventory platform, who are like normally the best set up to adopt it, right? Or the folks who, start leveraging these like intake reportings and BI reports and whatever it is, right? Like, it's those who understand the operational need for a thing as it relates to tasks to be done, right? Checking to make sure you're inputting wholesale prices incorrectly, checking to make sure that the thing is defective, right? Making sure that you're creating an order that is the right size to turn over within net terms, right? Like all those types of things. You kind of know that need going into it, right? Which allows you to be able to adopt and have those things, because then you'll realize like, oh, like the existing stuff I have is not going to get me there, right? I would say that a lot of times you have to be educated on that need ahead of time, right? And this is why it's important to know these benchmarks and know these things that have happened, as opposed to reporting for reporting's sake, right? What you don't need is a giant list of numbers that you have no idea how to use, right?
Yeah, no doubt.
Yeah.
Yeah, that just becomes noise, right?
Yeah, right. Like the action is more powerful than the information.
Yeah, I think the most important thing is just to track this stuff in real time. A lot of people they'll get lazy about it and they'll just like after 6 months go back and look at everything and say, oh, where did we go wrong? But if you're
Mm,
looking at it every month, or in the case of the inventory stuff every week, you can correct it as it's happening so that you don't make those mistakes and cost you more money.
yeah, no doubt. All right, so like similar-ish theme here is on the subject of like pricing and brand negotiations. So when it's not an intake error, when you're noticing, the sale price is not being achieved that it should be, the margins are not being achieved like they should be with those brands. Um, do you renegotiate price changes with vendors based on their entire line, or do you do it on a SKU basis?
I've seen it both ways. Probably more on a SKU basis. There'll be certain products that they can't sell, so then they have to discount it to sell it, and now it really cuts into their margins. So you can go back to them after the fact. Maybe not after you sell all of them, but you sell a few of them and say, hey, you sent me 30 of these products. I couldn't sell any of them, so I just discounted 5 of them, and this is the price I got. I want to get rid of the rest of it. I could either send it back to you, or I could sell it at the price I just sold it at. But I would appreciate some sort of credit because this didn't sell well at all, and it really hurt my margins. And it becomes a negotiation. Obviously, they might come back and say, well, this is the best I can give you as far as credit goes, but uh, you know we're not responsible for that. But typically they want to keep that relationship going because they know that being able to sell to you consistently is really good for their business. They know what they're getting, and um, I've never seen an issue where if it was a reasonable request, that they wouldn't grant you some sort of credit.
What you have to be mindful in my mind is like, you should talk about like that 4-year market cycle, right? SKU proliferation is a huge chronic issue in the industry. And part of it is like, you have to understand the incentive of the vendor. The vendor wants 100% of everything sold at your store to be something that vendor provided, right? Like that's what they want. And in order to do that, particularly as markets mature, they have to chase SKU variability. They have to try different products. They have to try different strains. They have to try different extract methods, right? Like flavors, like all kinds of stuff. So their incentive is to try to get as much of their catalog onto your shelf as possible. But the reality is like your consumers, like, so you talk about the fact that a bud tender isn't going to list 10 different possible flavors, right? That you can have and say, which one do you want to choose, right? They're going to recommend the best, the one that the consumers like the most, the one that gets the most feedback, the one that gets the reliable upsell, the one that pushes the 70 above 75, right? Which means that like for any given brand catalog, there's really only like 20% of those products that really move. And I think, and this is part of like, one thing our tool does is like, we do product lines and we prioritize the movers over the non-movers. But again, it's like those things, like just, you got to be mindful of the fact that like, if the vendor is sending you a ton of cases that has a giant catalog, it will include some that won't move that you will then be in that situation with, right? And so you really got to be like diligent about that feedback and understand like, unfortunately, the incentives aren't totally aligned there, right? You do not need 1,000 products on your menu. You just don't, right? So.
I got a couple more questions that just came in. When popular brands are being sold at 40 to 50% margins by larger chain dispensaries nearby, do you see stores being punished for marking it up to the correct 55%? Do customers leave in general for a price difference nearby?
That's always a risk, obviously. As competition happens, people are looking for the best possible price. It really depends on the market. A lot of people are just creatures of habit. If they like your store and they're used to coming there, and you have a good text marketing campaign to bring them in, and the experience is always great, they typically wouldn't leave for a small difference in price. Um, Same thing that goes with anything. That goes with our services. I'm sure your services. We provide very good accounting services. We charge X amount per month based on their need. And if a client of ours goes price shopping and finds someone who does a similar service for, 15-20% less, they typically wouldn't leave, because it's just such a hassle and inconvenience, and they're creatures of habit. They like what they're getting, everything's working. But yeah, obviously, if their price is a lot less, 50% less, then yeah, that's significant enough where it's like they have to think about that and do that.
Yeah. Yeah, I would say, like, you do have to follow along with that 25%, but also remember the fact that you don't know that they're actually selling it at a 40% margin or 50% margin, right? They could definitely be selling it at a 55% margin. They just get a better deal with the vendor, right? So at the end of the day, it actually is negotiation leverage back to the vendor to be like, I need to meet this price so that I have consumers. So can you push it, you know what I mean? Push it down, like, on some level, right? And I agree, like, with the expectation that, like, in year 2, your prices are going to fall 25%. You should expect that, right? Wholesale prices must do that, must follow, right? Like, that's just how it works, right? But I 100%, 100% agree with this idea of, like, do what's good for your store first and foremost. Consumers are creatures of habit. They enjoy good experience. They enjoy good bud tenders. There's a reason why people pay more money at Starbucks. Like, there just is, right? So anyway, I know we're at time. Oh, you're muted.
Yeah, I was just like, how do I unmute this? I wanted to make sure that we put up the contact information here. We are at time. However, I have one last question I want to make sure that we get to, because I do want to promise we get everybody's questions answered. And this one's a pretty good one. Are there any books or classes you can suggest for a new owner to become more adept at what KPIs we should be looking at? What financials are key to cannabis in particular? Just an overview of the important stuff for a new operator. I can say to this, at least from our side, you should go check out the Happy Cabbage blog, because we do actually write a lot about this. We just recently published some content about the top 5 retail KPIs you should be following, which very much goes in line with a lot of what we've been discussing here. So like following our webinars, checking out our content on our website are some good resources for some of those questions. But that's from us on the inventory and retail management purchasing side. Daniel, what would you suggest?
I would suggest 2 things on our end. Our website has, greengrowthcpas.com has different blogs for different markets, and a lot of times those blogs are tailored toward educational pieces on the retail end. We actually had one, I think, a couple of weeks ago that was up. That got a lot of traction, was very helpful. And then also on my personal LinkedIn, I do about 2 videos a week, and then I also have blogs in between. And usually once a week, there's a actual embedded document that if you write something in the comment, we can send it to you. And that a lot of times those are related to something related to the retail aspect, and top 5 KPIs, or something that's very educational, helpful for a dispensary.
Dope. Right on. All right. Well, at that, we should definitely say goodbye. Thank you, Daniel, so much for the time and the lively conversation. Thank you, everybody, for joining. If you want to reach out to Daniel and Green Growth CPAs, you can check them out right there, the email address. And if you want to get your inventory health audit claim for free, come check us out at happycabbage.io. There you can also enter into a 14-day free trial if you want to really like level up what you're doing on the inventory management side. So again, Daniel, thank you so much for your time. And we'll see you guys next time.
Yeah, thank you for having me.